Hey, everybody, this is Carrie from the Hippocratic Hustle podcast. I'm here, of course, with Victor. You all know him as the actual owner of this Facebook group, 39.6. But I am actually going to be interviewing him live here on this channel for the Hippocratic Hustle podcast. So I thought that we would go live because why not? And that's
Why
what
not?
you do.
That's what we do. That's the difference between getting something done and not done is going live.
Yeah, and so actually this was take two because we had a lovely mascot, Shanola, here, but she's
18 months.
Yeah, she was not helping the recording.
Yeah.
So we're starting again. So if you happen to see the other video, that was an epic fail. So
it's pretty amusing.
So we recruited my husband to babysit and my daughter. So hopefully they are managing the mischief upstairs and everything is under control now. So we're going to try this again.
All right.
So now for my editor, I'm going to be starting off the podcast. This is where we'll begin the podcast starting right now. Welcome, Victor from 39.6 to the Hippocratic Hustle podcast.
Hi, Carrie. Thanks for having me. I love Denver.
Oh, thank you so much for being here. This is really fun. We have you live in studio. AKA my office.
Home office. Note IRS. This is a home office.
It is indeed. And it is being used exclusively as an office.
Exclusively as an office.
And
absolutely.
I'm not even being sarcastic.
Yeah. And actually, I was going to make a sign so you could put on your door and take a picture of that in case they want proof.
Hippocratic Hustle headquarters right here.
Exactly.
I like that. Well, thank you so much for being here. We're going to be talking about we're going to be talking about 7 common tax terms explained because it is tax season. 'Tis the season.
It's the season.
And there are a lot of tax terms that I think people take for granted. They may not know exactly what it is. And I know there's also some people who are very seasoned and this is pretty darn basic. But I wanted to kind of, bring it down, take it back, get back to the basics, and basically go over these really simple terms and make sure that we all are on the same page and that we all understand. And also there's been some changes for 2018. So these are things that you need to be aware of.
Absolutely.
So I thought we would start with the common term withholding. So a lot of people get a bit confused about what withholding is. So let's talk a little bit about that.
All right. So if you are an employee and so you have an employer, you had initially fill out some paperwork to become an employee. And part of that paperwork told them all of your information for taxes, for your Medicare, Social Security, so it could get attributed to you as well as your income. But alongside your income, they have to keep a portion of this as what we call withholding because the IRS wants to get paid taxes as you go. It's a pay as you go system. So they're taking a portion of every paycheck. Now, we don't know how much tax you will actually have to have paid by the end of the year. It becomes very complicated. It's based on your deductions and your credits, which we'll get into, but it's just an estimate. And that way the IRS gets something along the way. And that way you don't have to worry about paying, for example, an entire year's worth of taxes in one big check.
Yeah, this was a common misconception because when I was in high school, my social studies teacher actually went on this long rant. This is like one of the few things I remember from high school. But he said, why would you give your money? Why would you give them a free loan? Why would you give the government a free loan with your withholding? And so he was trying to teach us something. But what he didn't really teach us about is that you need to be paying your taxes as you go, or you'll be required to pay a penalty at the end of the tax year.
They will charge you an interest rate on top of that. If you are a business owner, you have to pay quarterly estimated taxes. If you are a business owner and a W-2 employee, you do not have to do quarterly taxes, but you should account for that and potentially increase your withholding. So that's what we do. We don't pay any separate quarterly estimated taxes for our side income, but we do make sure our W-2 withholding is enough.
Right, because you have the W-2 to be able to do that.
Absolutely.
If you're all 1099, you'd have to pay quarterly taxes.
Just pay quarterly.
Yeah, or if you're W-2 and you were not really thinking about it and you're not paying an increased withholding to accommodate for your 1099 income, you could still pay a penalty at the end of the year.
Yes.
Which I did actually last year.
Wow. So there's you don't have to pay all of what you need to pay. as long as you pay, for example, 90% of it, then you're fine. This year, because of the changes, they're letting you be okay with at 85% of it. These are called the safe harbor rules. But the other safe harbor rule, which is what I use going through the year, is just as long as you're paying as much tax by withholding as you had to pay last year for the previous taxes,
Right.
then you're fine. So that's basically, I kind of write that number down, and I just make sure like every month we've paid about 8% of that number. And that makes sure that we're kind of getting to meet our safe harbor.
Yeah. So good. There's some accommodations for that, but that is what withholding is. Super important to understand that many people, when they're doing their taxes, of course, they get their package back from their accountant, and their accountant says you're going to need to cut a check for a couple $1,000s, maybe tens of thousands of dollars. And we've heard people say, I owed more in tax this year. And that doesn't necessarily mean that you owed more in tax. It just means that you didn't withhold enough, and you actually this year didn't withhold enough to cover all of your tax burden.
Right.
Correct?
You could be actually paying much less tax this year for 2018 than you were paying in 2017, assuming the same income. But you might not have withheld enough, and you're just paying the difference. So you're just basically squaring up with the IRS. A lot of people get alarmed when they have to write a check, but once you understand how taxes works, then you're actually pretty happy when you're writing that check.
Right. That means that your paycheck was a little bigger each time you had it.
Exactly.
So sorry, let me start that over, editor. Thank you. So gross income is the next thing let's say that again. Gross income is our next topic on the list of the 7 common tax terms you should know. So tell us a little bit about gross income and what that means.
So gross income is actually not a term that's on your 1040, your tax form at all. Gross income is a general term that we use to refer to all of the money that you get paid by your employer, okay, before all of the deductions are taken out, like insurance premiums or your 401k employee contribution. So that's basically your gross pay before taxes.
And is that the equivalent of like when someone says my salary is $200,000, that's your gross income?
That's what usually, people are referring to when you have a contract that says your salary is X, then that is usually what they're referring to as gross income. But for me personally, I look at the whole package.
Right.
Right. So you have to look at what your salary is or your hourly and look at your benefits. And some of those benefits are actual dollars. Okay. So like your 401k match, those are actual dollars. So I include those numbers in what I call total compensation. Now there's other benefits you get like healthcare benefits, and you can put a number on the value of those, because if you are self-employed and potentially paying for that yourself, you want to make an apples to apples comparison. But I look at personally total compensation, which includes the employer match and all of your gross income as a whole package.
Yeah, that's a good point. So how is that different from adjusted gross income?
So your gross income is basically like, all of your earnings. Now, when you do your taxes, if you're just a W-2 employee, okay, there will be a box on your W-2 form that says wages. And that was basically your gross income minus the amount of money you put into your 401k and minus the amount you put into your like healthcare premiums and other we call pre-tax deductions. Those are deductions that they don't even show up on your W-2. Those are actually the best deductions to have. It's like that money never happened. Okay. Now, once you have your wages on your tax form, if you have other income like from your investments or from a side business, all those other incomes, you add them together to make a term called total income. Okay, but from there's adjustments, which are now what we refer to as above the line deductions. This is an old term. There's no actual line, but when you look at an old 1040, it was a 2-page document, and the bottom of the first page was your adjusted gross income. That number was also the top of the second page. And all it was is your taxable income minus a few select deductions that they want to make sure that everybody is able to take without having to itemize, which we'll talk about later. But some of the most basic ones were student loan interest. A lot of people, like when I was in residency, you claimed your student loan interest to a certain amount that caps, but you lose that once your income becomes too high. If you are self-employed and have self-employment tax, then half of that is also an adjustment to your total income. If you're moving for a new job, that used to always be an adjustment, but with the new tax laws, it only applies to military. So it's basically just a handful of things. The other big one is traditional IRA deductions. If you are able to deduct your IRA contribution, if your income is low enough, that is also considered a deduction. Because if you know when you have an IRA, that money comes out of your bank account. Money in your bank account has already been taxed. So to make it go back to being pre-tax, you have to be able to take that deduction. And so that shows up there. So those are the most common above the line deductions or adjustments.
Yeah, and I encourage people to look at a 1040 and see what we're talking about, because it's all laid out there. And so you can kind of see what different things are on there. I think sometimes we take it for granted a little bit and we don't look back at our tax returns, but this is something that would really make sense and help you understand it a little bit better.
Yeah, and if you look at the 2017 1040, it's laid out like very clearly on the first page. They made the new taxes simpler by making it more complicated. They took a whole bunch of things off the 1040, like all of the adjustments. They are all now on Schedule 1. So you have to fill out a separate schedule, and then that plugs back into the 1040. It's the same information, but they just basically broke 8.5 by 11 sheet of paper into a postcard, which requires now multiple postcards.
Right. So now you need to look at Schedule 1 in order to understand what we're talking about, as opposed to last year or 2017, when you could have just looked at the whole 1040. That's a good clarification. So that's adjusted gross income, because we use the adjusted gross income to figure out what we owe for our taxes. So that's important. But the next thing we wanted to talk about is exemptions.
Right. So these terms get very confusing, right? So we talk about deductions, we talk about exemptions. They both have the same effective meaning. And as basically there's certain dollars that we don't have to pay taxes on. So in my videos, I like to refer to I call the 0% bucket. So whenever you look at a tax table, it talks about all the tax brackets, but they never include the 0% bracket. Okay, the 0% bracket is all the money you earn that isn't getting taxed. Okay, so anything that was an exemption, okay, would be money that would go into that 0% bucket. So in 2017, for every person in your family, you got a $4,000 exemption. So if you're the Brady Bunch, I'm trying to think of the names of the mom and the dad. Might not get it, but they had 8 people, and then there was Alice, but I don't think she was part of the actual family. I don't think they were claiming her as a dependent. So they had 8. So they would have had $32,000 in 2017 of exemptions, 4,000 times 8, which would mean that $32,000 they earned would have no tax implications at all. Okay, but this year, with the new Tax Cuts and Jobs Act, exemptions is gone by the wayside. So if you have a large family of 9 kids, or Kate and somebody plus 8.
Oh, yeah. Well, they booted him.
Oh, okay.
They booted the husband.
Well, Kate plus 8.
Kate plus 8.
Yeah, she had 9 exemptions in 2017 in theory, and in 2018 she has 0 exemptions, or she has 9 exemptions times 0 because there is no amount for exemptions. So that no longer exists, and it's kind of a penalty to larger families, but it is what it is. But if you had a very high income before, even if you had a big family, you also got phased out of exemptions. So anyhow, it's gone from the new tax laws.
So that's the new stuff about exemptions.
For the federal tax.
For the for the federal tax.
Right. Because in your state, you could still have exemptions.
Oh, yeah, yeah. Well, every state's different.
I know.
It's super complicated.
That's why everybody should move to
level.
Texas.
Right. There's no state tax.
Actually, I think everybody is moving to Texas. So I just keep moving there. It kept driving up all the prices of real estate. All right. So that is your exemptions. Okay. And then so after that, okay, the next important portion. Okay, so everything on the basically was the second page of your 1040 before is all of the subtractions. Okay, so we would subtract your exemptions and then we subtract your deductions. Okay, now if you're married, this is again, this goes to basically what I call the 0% bucket. Everybody is allowed to take what we call the standard deduction, and it has gone up a lot. It used to be like $12,000 in 2017. I think it might have been, it was actually 12,600, but about 12,000. And now it's about twice as much, it's 24,000 for married people. Okay, but they got rid of the exemptions, so it's kind of a trade-off. So everybody gets $24,000 if you're married of income that has no tax implication. So if you made $24,000 over the first 2 months of the year and you stopped working, you would have no tax liability. So any money that you had withheld from your paycheck, you would get 100% of it back once you filed your tax return.
Yeah.
Okay. So that makes it easy. Everybody gets $24,000 if you're married. Okay. It doesn't matter how many children you have. It's $24,000 minimum if you're married. If you're single, it's $12,000. And if you're head of household, which is always I always was confused what that meant. It basically means that you have like a child, but you don't have a spouse. So you end up having $18,000 because it's like having 1.5 people.
Oh,
I know. That's the way they see it. But you do get a child tax credit, which we'll get to later. So it's a little bit more than 1.5. Okay.
All right.
Okay.
Works out in the end.
Right. So, okay. So that's actually super easy. In 2018, the vast majority of Americans are taking the standard deduction. Okay. So if you're a W-2 employee, you're taking the standard deduction, you can have your taxes done in like 10 minutes. You can actually get your taxes done probably faster on paper than going through like TurboTax, because TurboTax asks you so many questions. It asks you so many questions to see if you're going to itemize, which I'll get to. But if you know you're not going to, you can skip all those questions. Okay, it's like you're getting interrogated when you go through the software.
It's true.
You could just say, I'm taking the standard deduction, here's my W-2 form, and you're done with your taxes. It's so fast, okay? But some people have more than $24,000 worth of what we would call itemized deductions, okay? So in the way it basically works is you can choose a standard deduction or you can choose itemized, and you just want to choose whichever one is higher. Okay. Now, I personally like to think of it as everybody gets $24,000 free first. Everybody takes the standard. And then what I think of is you look at all of your itemized and you take 24,000 off of it if it's over 24,000. Okay. Because there's a misconception about how much mortgage interest actually helps people, which is kind of a separate topic. Right. But everybody gets that 24,000. If you have $25,000 of itemized deductions, yeah, you're going to choose $25,000 to deduct, but you're really only getting $1,000 more than you would have. So it doesn't really help you having all those deductions that you actually had. Yeah. Okay. It only helps you a tiny amount. It'll save you like $300. Okay. But those itemized deductions, the big ones are mortgage interest, state tax for people who don't live in Texas or the other non-state tax states. Okay. And then charitable deductions is another big one, potentially for some people. Sales tax, if you don't live in a state income tax state, you can use that. And then there's also your property tax. Okay. So all of those, basically those taxes, as well as charitable deductions, in 2017, you could just basically add them all up. Okay, sometimes you had to choose between like the sales tax or the state income tax. Okay, but basically, yeah, you just add up all those things and somebody could have an incredible amount of itemized deductions. Okay, let's pretend you had $1 million house at 4% interest. That's $1 million mortgage at 4% interest. That's $40,000 tax deduction. Okay, and let's say you lived in California. Let's say you're making $300,000 a year and you're paying, let's say, 8% state tax. That's another $24,000. So between that and your home, that's already $64,000, and we haven't added property taxes to that either. Okay, so people could have a lot of deductions. Unfortunately, one of the biggest change, one of the biggest changes that the new tax law has, which has everybody up in arms, is the limitation on SALT. Okay.
State and local tax.
I was thinking more about the SALT because it's so cold out right now and it covers the bottoms of your cars. But you know what? I did see a post today about somebody thinking about investing in a car wash. And I said, well, if you had SALT, then that really helps your car wash. But that's off topic. But the SALT, state and local taxes, all of those combined, you can only capture 10,000 of it.
Oh, it's so low.
Even if you have $1 million house with a $20,000 property tax bill, okay, I was talking to you, people in no state tax states, because they have to get paid somehow. All right, you in that $1 million house, you used to be able to deduct the whole 20,000. Now you can only deduct half of it. So maybe it's time to cut your house in half if that's where you're at. Okay, split it into a duplex, rent out the other side, and just claim $10,000 of property tax. Yeah, I want to get every little ounce you can, right? But yeah, if you're in a state like California or New York and you have high income, you can't really do much about your state tax. Your state tax is there. And so a lot of people in those states, they're very upset that even though they might have $50,000 that they could have used beforehand, they can now only use 10,000 of it.
Right.
So in effect, they're actually getting double taxed because you're paying a tax to a state, but the money that you just paid to your state, you're getting taxed on it at the federal level also.
Well.
Yeah. So
don't think about it too much because you'll get angry. Or maybe you should, and then we can vote.
Yeah, which is why the state taxes can't be like 50%, because if you added that on top of, then there would be no money. Like you would literally be working and more than all your money would be going to tax, right? So because it's additive, it can't be more than like 10%-ish in the bad states, okay? But yeah, the biggest thing is SALT limitation, okay? Now, charitable contributions are still included as itemizable deductions, okay? So basically cash that you donate or things that you donate that aren't cash, if you can have a valuation for them, like I use a donor advised fund, and then we always have a bunch of boxes that end up making their way to Salvation Army. You know, we itemize those things and count those as charitable deductions. Now, it's not infinite. You can only count about, I think, 50% of your adjusted gross income as charitable deductions in a particular year. Otherwise, it just carries over. But yeah, those are your itemized.
And again, we're trying to get our itemized deductions higher than the standard deduction.
Exactly.
So if our state and local tax caps at $10,000, then that only leaves us with $14,000. So you would need to contribute $14,000, well, more than $14,000 in order to do the itemized deduction if that's the only thing that you're itemizing.
Right.
So that's why it's different than before, because you could, take a box to Goodwill and charge, say it was $200 in value, and you could put that on your itemized deductions, and it
basically you're always getting it, right?
Yeah. And it helped a little bit.
Right. But yeah, with the limitation on SALT, between $10,000 and whatever your mortgage interest is, so let's take an average house in the Metroplex where I live is about $300,000. If you're putting 80% of that on a mortgage, so $240,000 at 4%, then you have about $10,000 of mortgage interest. You add that on top of $10,000 from your other taxes, you're only at $20,000.
Okay, you're getting a little closer there.
Getting closer, but still the standard's ahead. So if you're deciding whether or not you want to donate money this year, and let's say you just decide to donate $4,000, okay? Well, you can, but that $4,000 would just get you to $24,000, which would be the same as taking the standard. So you're effectively not getting any deduction on that charitable donation. Okay, so some people are going to do bunching of their deductions. So they might this year take the standard deduction, okay, because they don't want to pay $4,000 just to break even on the standard. But then next year they may donate $8,000, and that way they'll at least go and be above and beyond the standard deduction and get an extra $4,000 of deduction, which could save you $1,200 or so. And basically, you'll at least get some money back.
Right. And this is why a lot of people are using donor advised funds. And this is a whole other topic that we probably should do as a separate podcast. But the donor advised funds is a way that you can donate money each year into this fund. And then it just kind of sits there and it doesn't really count until you release it. Correct? Am I saying that right?
Well, it sits there and is invested.
And invested. Yeah. No, it doesn't just sit there.
So this is how you create your own personal endowment trust. So you can basically fund charities from this.
So every other year you could put $8,000 into it rather than $4,000 each year that you might have given to your church or to whatever charitable organization you give. And then, so you do $8,000 every other year. And then every year your donor advised fund would give that church $4,000. Yeah. So they would still, your church or charitable organization would still see the same donations that they always had seen every year, but your taxes would see it every other year.
Right. So you would just basically be able to save more on your taxes, and the people receiving it would still get what they otherwise would have gotten. And if it had growth over the next year, you could donate more.
Right. Exactly. So you have a little bit extra for your charitable organization. So donor advised fund is something to consider if you are not able to quite hit your above the standard deduction.
Right.
So something to think about for next year.
And if it's December and you're thinking about making those charity donations, so I always estimate my taxes on December 1st approximately. And I look at where I'm at and am I going to take the standard deduction or not? If I know I'm already going to itemize, then I'll donate, no problem. But if I'm still under that 24,000, I might wait until January 1st and then make those donations. That way it'll count for the following year where I'm then most likely going to then itemize.
Right.
So
not a bad idea to have a donor advised fund set up so that you have a little place to put that money and kind of shuffle your money around to basically just optimize your deductions.
Right. And last year, or the end of 2017, they came up with a new tax law with a week to go.
Right.
So that gave very little time for people to actually make plans as to, well, this is what the new tax law is going to be. Well, maybe I'm not going to itemize next year. Maybe I should take these deductions now. It gave very little time for tax planning.
Right.
But that's just what happened.
And if you recall, that's why everybody was trying to pay their state tax, or their property tax early. And it drove all the local governments mad because people were lining up to pay their taxes, and the county wasn't able to take all that. They just weren't used to that.
I would have paid 5 years in advance if I could have. Cashed it all out, because I would have taken a 39.6% deduction on all of it.
Yeah. So if you remember back a year ago, that's what people were doing, and that was made for some interesting news headlines back then. All
right. So we were at taxable income, and then to get from taxable income to what you actually have to pay, we were at adjusted gross income. And you subtract your exemptions, which is 0, and you subtract your deductions. And you basically choose standard, 24,000, or itemized, taking into consideration the limitations on SALT, for example. And once you subtract your deductions from your adjusted gross income, you get your taxable income. Okay? And that taxable income is what gets put into the special tax calculator. Okay, that goes through the marginal tax rates for every single bin. Okay, and
that determines your bracket, your tax bracket.
So you have all the different tax brackets.
Yeah.
And so let's pretend just off the cuff, somebody makes $200,000. Okay, that they don't have any adjustments. Okay, and they don't have any itemized deductions. So they're just taking the standard deduction. So they started at $200,000 of wages. They had adjusted gross income of $200,000. Okay, then they have $24,000 standard deduction. They're at $176,000. That's your taxable income. Okay, then you have to go through the tax brackets from there. So a portion of that will be taxed at 10%. Okay, then some at 12%. Okay, then some at 22%. And it goes up until all of your dollars are used. Okay, and that is the money that number, your taxable income, is ultimately what gets put through there. Okay, you have to go through all of those buckets in order to calculate how much tax you actually owe. But the way it works is the more you earn throughout the year, the more tax you're paying on the dollars you're earning.
Right. So I think a lot of people think that, if their income is 200,000, then they might be taxed at what percentage? About 35?
Sure.
Yeah, I can't remember where it is. So but you can't just subtract 35% from your income and that's what you're going to pay. It's going to be less than that, okay?
Much less.
Because 100% of your income is not taxed at 30% or 35% or whatever your tax bracket is. That's not how it works. So you have to go through the different categories and add up how much you owe for each one. And there are different graphs and calculators online that can do this for you, so you don't have to sort it out. And in fact, Victor on his website 39.6 has different charts that will help you figure it out. They're really quite gorgeous, and it reminds me of the nomograms that we had in medical school. Yeah, exactly. So I love graphs. So basically, this can help you figure out exactly, or at least estimate, what your tax burden will be based on your adjusted gross income, because you cannot take your adjusted gross income and just multiply it by 30% and figure it out that way. It's a little bit more complicated, but it's in your best interest to have this sort of system where it goes by categories and by brackets, where we're paying at different levels for each income level.
Yeah, that's progressive tax.
Progressive tax. That's good. There's a term for it because it's complicated to explain.
So yeah, if you had a $200,000 adjusted gross income for 2018 and you take a standard deduction, you would be paying about $31,000 in total tax liability. Okay, so you would be going through the 10%, 12%, 22%. And the last $10,000 you earned would be at the 24% level. Okay, so that 24% level, we call that your marginal tax rate, because your last dollar was taxed at 24%. But not all of your money was taxed at 24%. In fact, you only paid $31,000. And if you earned $200,000, well, that's 15.5% on average.
So that's your effective tax rate.
Boom, exactly. So there you go. That's your federal effective tax rates. You're still paying Social Security, Medicare, potentially state tax. Okay, but yeah, once you have that taxable income, you can just basically plot that on the chart and use or go through any tax table as long as you follow it properly, and you can figure out what your tax liability would be if you don't have any tax credits.
Right.
Okay, so tax credits, now these are the good ones.
Ooh, credits.
Yeah, so
this is what you want.
Yeah, Dave Ramsey hates credit.
Oh, you mean like credit cards?
Oh, well, yeah, he hates credit no matter what. But these are the one credits that he probably would approve of.
Yes, indeed.
Yeah, tax credits, okay? Now, tax credits are so much more powerful than deductions, okay? Even for the very high income people where your deduction is worth a lot. Mm-hmm. It's worth 37%. Okay, every dollar of tax credit saves you $1 of tax.
Love it. 1 for 1.
So it's 3 times stronger than a deduction for a high income person, or like 10 times stronger for somebody who's in the 10% bracket.
Nice. Yeah, exactly.
And there are some credits where you can have no tax liability and they'll still actually pay you. Indeed. So it's like then you actually have a negative, effective, and marginal tax rate. Mm-hmm. It's pretty cool.
Yeah.
I mean, I don't ever want to be in that position. But
right. No, but it could happen.
Yeah, absolutely.
So I have an example of this. I actually bought an electric car this year. I did.
I used to drive a Nissan Leaf, actually. I love electric cars. Yes.
Okay, that's what I bought. I have a 2018 Nissan Leaf.
I saw it in the driveway.
Amazing. I love it.
Now, how does it handle the cold?
It's not very great in the snow.
Well, how about the coal?
tires.
Does the
Oh,
battery?
the coal.
The
Yeah,
battery still okay?
no, I mean, a lot of people think that that's a big deal, but driving around town, it's not a problem at all. It does decrease your range a little
Yeah.
bit, but it's not a big deal. And the 2018 versus the 2019, we're getting into or the nitty gritty of the Leaf. It doesn't have a lot of the battery climate control for the battery that the 2019 does.
Oh.
Which Tesla is, of course, a nicer car. Yes, it is. And so it has a lot more of those fancy features for the battery so that the battery will not be affected by the climate as much.
That's interesting because I had my Leaf in Houston, which is the exact opposite.
Yeah, but it gets too hot.
It gets really hot. And so the range was also decreased.
Yeah, indeed.
It was like having to pay taxes on your range.
Yeah, exactly. Heat tax.
Yeah.
So anyway, but I get a tax credit for that.
Wow.
It's $7,500.
Now, if you bought it for $7,500, that would be a steal.
It'd be a free car.
It would be.
However,
I would have bought two.
Yeah, exactly, me too. But it was not $7,500. But it does help the overall cost of the car.
Absolutely.
It just was something that I have to now take advantage, even though I bought it, 6 months ago. I had to wait for doing my taxes until I could get my credit back.
So if you bought it like on December 31st, you could have claimed the credit, right? Still for 2018.
That's right.
Even if you are paying it on monthly payments.
Oh, indeed. I mean, if it's financed,
Yeah, so you could be paying like $300 a month. And then in April, you get this check for $7,500. So now you're positive cash flow in your car.
Yeah.
This is pretty sweet.
Kind of, no. But yeah. But it really
I want how many of these can I buy? Can I buy like 10 of these and get $75,000?
I think you can definitely buy more than one and still get the credit. I think
interesting. I should look into
this.
this.
What the limit for electric cars, however, is that there were only so many that the company could sell, and then it phases out the tax credit. So Tesla, for example, has sold enough of their cars that they are getting phased out now. So you have to really look at it and see if you can get the car. I know.
So the sticker price isn't actually the sticker price.
When the tax credit was in effect, kind of, exactly.
Interesting thing.
Yeah. So, so that's a nice.
They probably put the sticker price, assuming the credit, to really attract the buyers.
Well, I don't think they can do that, but they could use it as a sales pitch.
Okay.
Trying to sell.
So that's a big one.
Yeah.
So it's $7,500 tax credit. Like if you're at the 33% marginal tax rate, then that's like a $22,500 deduction, which is more than you're getting on your state and local taxes.
Oh my God. I didn't even think about it like that. That's cool. Wow.
Yeah. So, I mean,
who
needs to have state local taxes when you could just buy a Nissan Leaf?
That's right. And you're saving the environment.
Why don't you buy one every year? Give me the one you're done with.
Right? Yeah.
Let's keep claiming the tax credits.
Yeah. Well, you could until they sell enough of them, and then the tax credit phases out.
Okay. So, excellent. Now, that's pretty awesome that you have that credit. But most people are not going to be able to capture that one. The most common tax credit people are going to take this year is on the kiddos.
Oh, the kids. Yeah.
Absolutely. So they didn't get rid of the tax benefit of having children completely. Okay. People with a lot of kids already were pretty up in arms about the whole loss of exemptions. But then you have the credits, which in fact are better than having the exemptions, because for people who are earning, if you're married and you're earning $400,000 or less of taxable income, I believe is based on, then basically you can get the full credit of $2,000 per child. Okay, so we were talking about exemptions before on the people in the family, and for every child you had to get a $4,000 exemption. That $4,000 exemption on old tax law was at the highest tax bracket, saving you $1,600. But now one tax credit of a child saves you $2,000 in tax. So the value of your child has actually gone up from a tax perspective. Now the child tax credit was in place before. So people who qualified for the child tax credit before and got the exemption, they got like a double bonus. But the child tax credit was only for lower income households. Now it's for basically 99% of Americans who will qualify.
Oh, okay. Yeah. So, right. But if you do have a household income greater than 400,000,
then it phases out.
It phases out. You're not able to take that.
Yeah. So if it phases out over a range, and then once the end of that range is done, then
nada.
No more. Then either have less kids, earn less income.
You can't go back.
You can't go back. Yeah. So yeah, basically,
Oh, yeah.
those are that's probably that'll be the most commonly used
Yeah.
credit this year. There are other credits for schooling and like lifetime learning credits and different things. There's all these different ones for education. Solar panels, yeah, that's a huge one.
Improvement to your home.
Absolutely.
In an environmental kind of way. I don't remember how they word that, but yeah, solar panels are included. I'm shopping for those too.
Yeah, these are nice. And especially if you, if you're paying already at a high tax rate, these credits are very, 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 very valuable. So, when the IRS wants to really incentivize behavior, they put them in the credit side. They still very much incentivize behavior by giving people deductions on things. But the credits really is where you get your most bang for your buck.
Yeah, definitely, because you can mentally do that math so easily. When I was shopping for the car, I knew that my overall cost of that car was going to be $7,500 less than my purchase price.
Right. It's like getting a rebate.
Yeah.
Yeah, people understand rebates.
Right.
People don't really understand taxes.
Yeah, right.
So,
well, our tax system is a little bit complicated.
It is.
Just a little bit complicated.
And it wasn't always as complicated, but when you take something, and I kind of remember like playing like football during recess in first grade or whatever, and you start playing, and then you just come up with all your rules.
Oh yeah, as you
go along.
Right,
okay,
right.
You have to count to 7 apples, and you can only blitz once, and the rules just keep changing. By the end of the year, you got a whole different set of rules. But with taxes, every time they change a rule, it just gets changed. And then you just keep adding more things on top of it. It just looks so complicated.
Right.
So the new tax system has actually simplified a lot of things just because most people are just going to take the standard deduction in the first place.
Yeah.
So that makes things a lot easier for a lot of people. But yeah, the tax code is very short for the simple stuff. And then there's more stuff written about all the other things than there is written about the core, because that's where all the legal stuff happens. But for a lot of people, taxes should be a lot easier this year.
Yeah. Well, that's great. So those were the 7 common tax terms that you should know, and to be sure that you are savvy and understand everything with your taxes this year. So thank you so much, Victor, for being here today.
Thank you for having me. It was worth the flight.
Yeah, right. Because that's the only reason why you're here in Denver, coming all the way from Texas.
Worth the trip, definitely.
So just as a reminder, this was for your educational and informational purposes only. Please consult your tax professional before you...
I think it's really for entertainment purposes.
Mainly entertainment.
Yeah.
Not as much information.
Yeah.
But I think we're just bringing some ideas to your mind and helping you understand what you may or may not know. And so you can go get more information from your professional tax consultant, and you can definitely make sure that you understand your personal situation. So thank you again, Victor. Please see Victor's videos. He has some wonderful videos, 39.6.com. You have to spell out point, but all those videos are there for your informational purposes and educational purposes. And you can learn all sorts of things about taxes. What other topics do you talk about?
So we talk a lot about taxes, real estate, just general investing stuff, and they're all on YouTube now.
Yay.
So I look up 39.point, and once I get to my 100th subscriber and 30 days of my channel, then I can actually get a URL that's not like 2,000 digits long or characters long. So I would love some more subscribers if you go on to YouTube.
Awesome. Well, thank you again, Victor.
Thank you so much.
Oh.
There we go.
Oh, okay.
And live broadcast.